Wednesday, December 17th, 2025, 9:30 a.m. The opening bell rings on the floor of the New York Mercantile Exchange. Normally, this is a non-event. Normally, the algorithms execute a standard opening range balance. They trap the retail longs, they run the stops, and they pin the price of silver exactly where the commercial banks need it to be. That is the script we have watched for 40 years. But this morning, the script didn't just break. It burned. Look at the timestamp on your terminal. At 9:31 a.m., a massive block of buy orders hit the COMEX futures market. It wasn't a gradual climb, it was a vertical liquidation event. The price of silver didn't just test the $65 ceiling. It smashed through it with the violence of a coiled spring that has been held down since 1980. In 15 minutes, we saw the price spike to $66.50. We saw the volume profile explode to levels we haven't seen since the Hunt brothers were cornering the market. And for the first time in a generation, the bullion banks did not step in to sell. They stood back. They let it run. And that silence, that failure to defend the line, that is the loudest signal I have heard in my entire career. They told you $65 was the resistance. They told you it was the line in the sand. They told you that the paper market had infinite liquidity to suppress the physical reality. They lied. The wall at $65 wasn't a ceiling. It was a dam. And the dam just broke. Welcome to capital cycles. We do not report the news. We autopsy the market structure. And the autopsy of this morning's price action confirms one forensic fact. We have officially transitioned from Mode B accumulation into Mode C the shift. Most people watching the ticker today think this is just another rally. They think it's inflation. They think it's the Fed pivoting. They are looking at the effect. They are missing the cause. The reason silver is trading at $66 isn't because of what happened in Washington. It is because of what happened in Beijing. While the algorithm was busy painting charts in New York, the Ministry of Commerce in China issued a document that the Western financial media completely ignored. Announcement number 68. It is a dull, bureaucratic piece of paper, but it contains a single sentence that effectively weaponizes the periodic table. Effective January 1st, 2026. The People's Republic of China is implementing strict export controls on strategic silver reserves. Let that sink in. We are not talking about a tariff. We are not talking about a tax. We are talking about a physical blockade of the metal required to build the modern world. The solar panels, the electric vehicles, the advanced semiconductors, they all run on silver. And the country that refines the vast majority of that industrial-grade metal just told the world that the window is closing. This creates a forensic divergence that the market is only just beginning to price in. On one side of the ledger, you have the paper market, the COMEX, the LBMA, a system built on the assumption of infinite supply and indefinite settlement. A system where you can sell 1 million ounces of silver that you don't have and settle it in cash. On the other side of the ledger, you have the physical market, the refineries, the vaults, the manufacturing supply chain, a system that cannot be settled in cash. A solar panel manufacturer cannot build a product with a paper contract. They need the metal, and for the last 5 years, these two ledgers have been drifting apart. We have seen 5 consecutive years of structural deficits. We have seen the registered inventory at the COMEX bleed down to historic lows. We have seen the above-ground stockpiles in London evaporate. But the price didn't move. Why? Because the smart money used the paper market to mask the physical shortage. They used leverage to convince you that silver was abundant. They used volatility to shake you out of your position. They defended the $50 wall in 2011. They defended the $30 wall in 2020. And they tried to defend the $65 wall this morning. But today, the divergence snapped. The paper market collided with the physical reality. And the paper market lost. This isn't a short squeeze. That is too small a word. This is a gamma squeeze on a planetary scale. The banks who sold call options at $65 are now structurally short the market. As the price rises, they are forced by their own risk models to buy futures to hedge their exposure. Their buying drives the price higher, which forces them to buy more. It is a mathematically guaranteed feedback loop. And unlike a stock, where the company can just issue more shares to cool the market, there is no central bank of silver. You cannot print it. You cannot digitize it. You have to dig it out of the ground. And the miners are telling us that the ground is empty. So here we stand. At the edge of the event horizon, the price is $66. The trend is vertical, and the consensus view is screaming bubble. They are telling you to sell. They are telling you to take profits. They are telling you that the banks will regain control. I am here to tell you that they are wrong. The banks haven't just lost control of the price. They have lost control of the inventory, and in a market defined by physical scarcity. The only thing that matters is possession. If you don't hold it, you don't own it. And if you think $65 is expensive, wait until you see what happens when the Chinese export ban actually goes into effect in 14 days. We are watching the end of a 40-year cycle of suppression and the beginning of a new era of price discovery. But to understand where we are going, we have to understand how we got here. We have to look at the mechanism of control, because the suppression of silver wasn't an accident. It was a design feature. For 40 years, the price of silver has been the most manipulated data point in finance. It has been held down to protect the validity of the fiat dollar, because gold and silver are the only honest report cards on government spending. If silver goes to $100, it is not because silver is getting more expensive. It is because the dollar is dying, and the powers that be, the commercial banks, the central planners, they cannot allow that report card to be seen by the public, so they built a paper wall. They saturated the market with unbacked contracts. They created a synthetic supply that dwarfed the actual geological supply. They taught the market to trade the derivative instead of the asset, and for decades, it worked. They broke the Hunt brothers in 1980. They smashed the price from $50 down to $10. They broke the retail frenzy in 2011. They smashed the price from $50 down to $14. They conditioned you to believe that every rally is a fake-out. They conditioned you to sell at the first sign of strength. They conditioned you to trust the paper price over the physical reality. But every Ponzi scheme has a mathematical limit, and that limit is reached when the physical inventory hits zero. You can print a contract, but you cannot print an ounce of silver to deliver against it. And that is exactly what happened this morning. The vaults are empty. The miners are tapped out. The recycling supply is drying up. And now China has locked the door. The commercial banks are staring at a delivery liability that they cannot meet. They are naked short in a market that has no close. This is why the price action is so violent. The market is trying to find the price that balances the books. And because the books are so unbalanced, the price has to go vertical. This is not speculation. This is a margin call on the entire fiat monetary system. The $65 level was the last line of defense. It was the Maginot Line of the paper market. And the panzer tanks of physical reality just rolled right over it. So what happens next? The history books tell us exactly what happens next. When a suppressed asset breaks its shackles, it doesn't just go to fair value, it overshoots. It goes into a manic phase of repricing. We saw it with palladium in 2019. We saw it with nickel in 2022. And we are about to see it with silver in 2026. But this is bigger than palladium. This is bigger than nickel. Because silver is not just an industrial metal. It is monetary metal. It is the people's money. And when the people realize that the paper price is a lie, they will rush to exchange their paper promises for the only asset that has survived every currency collapse in history. The window is closing. The train is leaving the station. And most people are still arguing about whether the ticket is too expensive. Do not be most people. Be the forensic detective. Look at the data. Look at the inventory. Look at the geopolitical chessboard. The evidence is overwhelming. The suppression is over. The breakout is real. And the era of cheap silver is gone forever. Class is in session. Let's examine the evidence. The question you should be asking right now is not why the price went up. The question you should be asking is why they let it. For 40 years. The bullion banks have operated as the gatekeepers of the price. They are the casinos. And the house always wins. When the price gets too high, they print more paper contracts. They flood the market with supply that does not exist. They smash the bid. And they trigger the stop losses of the retail speculators. It is a mechanism as reliable as gravity. So why did it fail this morning? Why did the commercials, the smart money stand down? Why did they let the price breach the $65 kill zone without firing a shot? The answer is terrifyingly simple. They are out of bullets. To understand why, you have to look at the lease rates. This is the most boring data point in finance. And it is the only one that matters. When a bank sells you a silver contract, they are supposed to have the metal to back it. If they don't, they have to lease it. They have to borrow a bar from someone else to prove they are solvent. Yesterday, the lease rates for silver in London went vertical. They spiked to levels we have not seen since 2008. This tells us exactly what is happening behind the curtain. The banks are scrambling. They are fighting over the last few bars left in the vault. They are not shorting the market because they want to. They are shorting the market because they are trapped. And this brings us to the history. Because we have seen this movie before. But the ending has always been the same. The banks win. The investors lose. To understand why this time is mathematically different, we have to go back to 1980, the year of the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt, two Texas oil tycoons who did the math. They looked at the inflation of the 1970s. They looked at the printing of the US dollar. And they realized that silver was undervalued by an order of magnitude. So they started buying, but they didn't buy paper futures. They bought physical metal. They took delivery. They flew it to Switzerland. They stored it in high-security vaults in Delaware. They took 43 million ounces of silver off the market. And the price responded. It went from $6 to $50 in 12 months. It was the greatest wealth transfer of the decade. The banks were bleeding. The shorts were facing bankruptcy. The entire COMEX exchange was on the verge of default. So what happened? Did the free market sort it out? Did the banks pay their debts? No, they changed the rules. On January 21st, 1980, the exchange announced Silver Rule 7. It was a new regulation passed in the middle of the night. It stated that investors could no longer buy new positions. They could only sell. Think about the criminality of that statement. Imagine walking into a casino and being told that you are only allowed to lose. The price collapsed. The Hunt brothers were margin called. They were forced to liquidate their physical holdings at a loss. The banks bought it back for pennies on the dollar, and the status quo was restored. This is the lesson of 1980. If you play by their rules, they will change the rules to beat you. Most people stop the history lesson there. They say the house always wins. They say they will just do it again. They say they will ban silver ownership. And that is why most people will stay poor. If you want to be part of the 1% who understand the shift, if you want to be on the right side of the wealth transfer, you have to stop thinking like a victim and start thinking like a predator. Make sure you are subscribed. Make sure you are in the network, because what I am about to tell you is the key to the entire puzzle. Now, let's look at 1997. 17 years after the Hunt brothers were destroyed, another billionaire did the math. Warren Buffett, the Oracle of Omaha. He didn't like gold, but he loved value. And in 1997, he saw that the world was consuming more silver than it was producing. The deficit was real. The price was low. So he started buying, quietly, without fanfare. He accumulated 129 million ounces, 3 times what the Hunt brothers held. But Buffett was smarter. He didn't use margin. He paid cash. And when the banks asked him if he wanted to roll over his contracts, if he wanted to settle in cash like everyone else, he said 2 words that sent a chill down the spine of Wall Street. Take delivery. He wanted the metal. He wanted the bars sent to London. The panic was instant. The lease rates spiked. The banks had to scramble to find 100 million ounces of silver that didn't exist. They had to ship it from vaults all over the world. They barely survived. But Buffett made a mistake. He was still playing within the system. He eventually sold. He let the banks off the hook. He took his profit and moved on. And the manipulation continued. For another 28 years, the price was managed. The volatility was crushed. And the paper leverage grew. Today, for every 1 ounce of physical silver in the COMEX vaults, there are more than 300 ounces of paper contracts claiming ownership of it. It is a game of musical chairs, with 300 people and 1 chair. And for 40 years, the music never stopped. But today, Wednesday, December 17th, 2025, the music didn't just stop. The DJ smashed the turntable. Because the entity squeezing the market today is not a Texas oil tycoon. It is not an Omaha investor. It is the People's Republic of China. And this is the forensic divergence that changes everything. You cannot margin call a sovereign nation. You cannot force Beijing to sell. You cannot pass Rule 7 on the Chinese Communist Party when the Hunt brothers bought silver. They were using leverage provided by American banks. The banks could cut the credit line. When China restricts silver exports, they are using their own sovereignty. They are using their own mines. They are using their own borders. The COMEX has 0 jurisdiction over the port of Shanghai. The LBMA has 0 authority over the Ministry of Commerce. The regulators in Washington can scream. They can hold hearings. They can threaten sanctions. But they cannot print silver, and they cannot force China to ship it. This is why the $50 wall fell. The banks looked at the board, and they realized they were no longer playing against retail speculators. They were playing against a geopolitical adversary that controls the supply chain. If they tried to short the market today, if they tried to flood the floor with paper contracts, China would simply buy them. They would take the other side of the trade. And they would say, take delivery, and the banks would default. It would be the end of the COMEX. It would be the end of the London fix. So the banks did the only rational thing. They stepped aside. They let the price go. They sacrificed the $65 level to save the exchange, but in doing so, they signaled to the entire world that the game is over. The mechanism of suppression is broken. The paper tiger has no teeth. And now we have to look at the statistical parallel. If this is truly the break, if this is the end of the manipulation, how high does it go? We have to look at the inflation-adjusted high. In 1980, silver hit $50. But $50 in 1980 is not $50 today. If you adjust for the official CPI, the government's own watered-down inflation numbers, that $50 high is equivalent to $160 today if you adjust for the real inflation using the 1980 methodology. Before they changed the calculation to hide the truth, the high is closer to $400. That is the gap. That is the asymmetry. We are trading at $66, and the real all-time high is $400. We are not at the top. We are at the bottom of the repricing. And we haven't even talked about the industrial multiplier. In 1980, silver was used for photography. It was used for jewelry. It was a luxury. Today, silver is used for survival. It is in the solar panel on your roof. It is in the circuit board of your phone. It is in the guidance system of the missile. It is in the medical device that keeps you alive. You cannot run a modern economy without silver, and you cannot substitute it. It is the most conductive metal in the universe. It is the most reflective metal in the universe. Physics does not care about the price. If Apple needs silver to build an iPhone, they will pay $65. They will pay $100. They will pay $500, because the cost of the silver is a fraction of the cost of the device. But without it, the device is a brick. This is called inelastic demand. It means the buyer has no choice. And when you combine inelastic demand with a fixed supply and a broken paper market and a geopolitical export ban, you get a vertical price line. You get a gamma squeeze that makes 1980 look like a warm-up. But there is one final trap. One final trick the banks will try to pull before they capitulate. They will try to convince you that the government will confiscate your gold and silver. They will bring up Executive Order 6102. They will tell you that holding physical metal is dangerous. They will tell you to buy a digital token instead. They will tell you to buy a mining stock, ETF. They will try to keep you in the electronic system, because as long as you are in the electronic system, they can freeze you, they can tax you, they can bail in your account. This is why the self-custody discussion is not optional. It is the firewall. In Part 3, we are going to execute the solution. We are going to show you exactly how to secure your position. We are going to break down the ARC strategy. And we are going to show you why the most dangerous thing you can do right now is nothing. The deep dive is complete. The history is clear. The mechanism is broken. Now, we prepare for the impact. So here is the hard truth. Knowing the crime is not enough. Understanding the gamma squeeze is not enough. Seeing the deficit is not enough. In a financial collapse, being right does not save you. Only position saves you. You can scream from the rooftops that the theater is on fire. But if you are still sitting in your seat when the roof collapses, you burn with the rest of them. We have spent the last 2 sessions analyzing the structural failure of the silver market. We have looked at the China export ban. We have looked at the empty vaults. We have looked at the mathematical impossibility of the paper shorts. Now, we have to talk about the exit. We have to talk about how you get out of the burning theater before the doors are locked. This is the transition from the analysis to the ARC. Most people think they are prepared because they own a silver ETF. They look at their brokerage account. They see the letters SLV or PSLV. They see a green number next to it, and they think they own silver. Let me be forensically clear. You do not own silver. You own a claim. You own a tracking error. You own a promise from a counterparty that is currently structurally short the very asset they promised to give you. When the real squeeze happens, when the price goes vertical, when the industrial users start panic bidding for physical bars, do you know what happens to the paper market? It doesn't go to the moon. It goes to zero. Or it goes to force majeure. This is the legal term that is buried in the fine print of every ETF prospectus. It says that if the fund cannot source the physical metal due to extraordinary market conditions, they have the right to settle your contract in cash. Read that again. They settle in cash, at a price they determine. So imagine this scenario. Silver hits $100 an ounce in the physical market. Apple is paying $100. Tesla is paying $100. The Chinese solar manufacturers are paying $100. But the COMEX declares a force majeure event, and they close your paper contract at $65. They deposit the fiat currency into your account, and they keep the metal. You didn't hedge against the crisis. You became the liquidity for the crisis. This is the trap, and this is why the arc is not a metaphor. It is a strategy of physical possession to survive the shift. You must become your own central bank. You must remove the counterparty risk entirely. This means self-custody. It means holding the metal in your hand, or in a private, non-bank vault that is in your name, allocated, segregated, and insured. If it is in a bank safe deposit box, it is not yours. In a bail-in scenario, that box is legally considered a liability of the bank. If the bank fails, your silver becomes part of the bankruptcy estate. You become an unsecured creditor. You get in line with everyone else. This is not fear-mongering. This is bankruptcy law. So what do you buy? You do not buy numismatics. You do not buy rare coins with high premiums. You do not buy collector's items. Those are for hobbyists. We are not hobbyists. We are liquidators. You buy weight. You buy the most liquid recognized forms of sovereign bullion, silver eagles, maples, Britannias, or recognized 100-ounce industrial bars. Why? Because when the panic hits, you need liquidity. You need an asset that can be recognized and verified in seconds. You are building a position that is fungible. Now, let's talk about the specific execution, because buying the metal is only step one. The arc is not just about hoarding silver. It is about the ratio trade. This is the secret that the dynastic families use to compound wealth during a currency reset. Right now, the gold-to-silver ratio is hovering around 70-1. It takes 70 ounces of silver to buy 1 ounce of gold. Historically, that ratio is closer to 15-1. It comes out of the ground at 8-1. When the squeeze creates the repricing event, silver will outperform gold. It always does. It is the high beta asset. It is the coiled spring. As silver goes to $100 or $200, that ratio will collapse. It will go from 70 down to 30, down to 20, maybe even down to 10. That is your exit signal. That is when you open the arc. You do not sell your silver for dollars. Never go back to the fiat currency that is burning. You swap your silver for gold. If the ratio goes from 70 to 35, and you execute the swap, you have effectively doubled your gold holdings without spending a single extra dollar. You have used the volatility of silver to acquire the stability of gold. This is how you lock in the purchasing power. This is how you secure the wealth transfer. But there is a final step, a step that goes beyond metal. The ultimate goal of the arc is not to bury gold in the backyard. It is to acquire productive assets when the dust settles. When the currency reset is complete, you use that gold to buy land, to buy cash flow, to buy distressed real assets that have been decimated by the interest rate shock in 1980. At the peak of the silver squeeze, you could buy a median-priced home in the United States for roughly 800 ounces of silver. Today, at $65, it takes roughly 6,000 ounces to buy that same home. That is the distortion. That is the theft. But when the reversion to the mean happens, when silver returns to its inflation-adjusted high, that ratio will close again, and you will be able to trade a monster box of silver for a deed to a property. That is the target. That is the mission. But you cannot hit the target if you do not have the ammunition. And you cannot have the ammunition if you are still playing in the paper market. The window is closing. I cannot tell you if it closes tomorrow, or next week, or next month. But I can tell you that the math does not lie. The deficit is real. The Chinese export ban is real. And the desperation of the central banks is real. They are trying to keep the beach ball underwater, but their arms are getting tired, and the ball is trying to rocket to the surface. This brings us to the philosophy of the shift. Why are we doing this? Why are we obsessive about the data? Why do we verify every ounce? Because this is not just about money. It is about freedom. Debanking is not a financial strategy. It is a political declaration. When you hold physical silver, you are voting against the system. You are voting against the inflation tax. You are voting against the surveillance state. You are voting against the idea that your labor belongs to the state. Silver is the only financial asset that is not someone else's liability. It does not require electricity to work. It does not require a password. It does not require a KYC check. It simply is. It is the truth in a world of lies. And right now, the world is drowning in lies. They are lying about the CPI. They are lying about the debt. They are lying about the employment numbers. And for 40 years, they have lied about the price of silver. But the truth has a way of surfacing, usually all at once, and usually violently. We are standing on the precipice of that violence. The $65 breakout was the first crack in the dam. The water is starting to pour through. Most people are standing in the valley. They are watching the TikTok videos. They are arguing about politics. They are distracted. They do not hear the cracking of the concrete. But you do. You are here. You are listening to this briefing. You have seen the forensic evidence. You have seen the supply charts. You have seen the export bans. You know what is coming. So the question is no longer what is happening. The question is, what are you going to do about it? Are you going to be a spectator? Or are you going to be a participant? Are you going to trust the banks that have failed you for 4 decades? Or are you going to trust the periodic table? This channel, Capital Cycles, it is not just a YouTube channel. It is an intelligence network. It is a community of people who have decided to opt out of the madness. We are the forensic detectives. We are the ones who read the footnotes. We are the ones who track the ships. We are the ones who prepare the ark while the sun is still shining. If you are one of us, if you understand the gravity of this moment, then subscribing is not just clicking a button. It is enlisting. It is raising your hand and saying, I will not be collateral damage. It is signaling to the algorithm that you want the truth, not the narrative. So do it now. Click the subscribe button. Turn on the notification bell. Because the next update I release might be the one you cannot afford to miss. The volatility is just beginning. The banks are not going to give up without a fight. They will try to crash the price one last time. They will try to shake you out. They will try to scare you back into the paper system. Do not let them. Stand your ground. Hold your position. And keep your eyes on the physical inventory. The paper price is noise. The ounce in your hand is the signal. The shift is here. The ark is open. But the rain is starting to fall. Class dismissed.